Hey everyone, this is Rahul with the Alternative Investors Hangout, and today we have here Jeff Nielson. He's at Bullion Bulls Canada, and he also is a writer at TheStreet.com. Thanks for coming on again, Jeff.
Hi, nice to be back.
Okay, you wrote this interesting article the other day, and it's regarding silver manipulation versus the non-existent manipulation of platinum. Can you explain why you believe that the platinum market shows why the silver market is most likely manipulated?
Well, I read this fairly detailed analysis of the platinum market that came out from a mining website. And, so it was refreshing in one sense in that you got some, detailed long-term data which showed how supply and demand fundamentals had affected the platinum market in a number of ways in terms of recycling, which had exploded by 400% over the past decade, and then, of course, in terms of the price of platinum, because with this surge in a new supply source, along with the fact that demand had been more or less flat, we've seen the price of platinum struggle. And so, that was, classic supply-demand analysis, because we were seeing price adjust until supply and demand meet in equilibrium, which, of course, is what the definition of a free market is. And what made that, for me, so glaring was when you compare this with the silver market. First of all, that the two markets are very similar. Both are, of course, precious metals. Both also are generally considered to be quote-unquote industrial metals today because they have numerous superb metallurgical and chemical properties, and thus they're used in a wide variety of applications. And also what makes them very similar is that these applications tend to use these metals in relatively small quantities relative to the finished product. So one would expect to see, with markets so similar as these, that the fundamentals in the silver market would play out in at least somewhat similarly to the platinum market.
So what about the inventory levels? I was reading about how there seems to be a depleted inventory levels in silver, but in the platinum market, it's a lot more, not reliable, I would just say it's more efficient than the silver inventory. Could you elaborate on this?
Well, yeah, you've seized on one of the key distinctions here, because one of the ways that we can tell when any commodity market is being suppressed is because there is an inevitable inventory destruction. I think, on one of our previous interviews on your site, I did my chocolate bar example, explaining how if you shorted the price of chocolate bars and drove them down 10 cents a piece, how, of course, that would result in the world being entirely cleaned out of chocolate bars. So this is what we would expect to see in any market where prices are being suppressed, is that inventories would be destroyed. And, of course, that's exactly what's happened in the silver market. The specific numbers I quoted were that from just 1990 to 2005, a 15-year span, we saw silver inventories plummet by 90%. Conversely, we look at the platinum market and inventories are abundant, which is an indication of a healthy market where there's not excessive manipulation of prices. So, I lost my train of thought here. Sorry, you were getting inventories in the silver market. Well, the thing is, if the price of silver is being manipulated and inventories are being destroyed, then we should see some sort of response mechanism, as there was in platinum, with a growth in recycling, for instance. But in silver, the recycling has been almost flat over the past decade, despite the price of silver rising by 600% over that span. So, you would expect a price increase of that magnitude to have spurred a similar sort of supply reaction that we saw in the platinum market. But that hasn't happened. In fact, silver mining remains extremely depressed. And as I just mentioned, silver recycling is flat. So in other words, even though there's been an increase in prices, that increase has not been even remotely sufficient to bring supply-demand equilibrium to the market.
All right, moving forward, I still want to talk about this silver alleged manipulation or silver constraints in the marketplace. And I don't know if you followed this, but there were stories stated by Ted Butler indicating that he believes that there is obviously a silver shortage, and when it comes to Apple and other companies, it's going to hurt them real hard right now and even in the future as these prices continue to go up. So do you see, number one, the price of silver hurting these firms like Apple, even though Apple is a rich cash flow company, but it's going to hurt their margins going forward?
Well, here's the interesting thing, and this gets back to what I was mentioning before about how silver and platinum tend to be used in small quantities. What this means in economic terms is that there's a very very low degree of demand elasticity. And what I mean by that is that because silver is only a small portion of the inventory, the price cost in making these products, the price of silver can increase by a very large amount and still have only a relatively modest impact on the final price of these products. And so the thing is, what this means is that on the one hand, manufacturers aren't going to feel the crunch right away, and of course neither are consumers, because there's not going to be large increases passed along to them as the price of silver starts to shoot higher. But conversely, this very low demand elasticity means that even as the price of silver increases, unlike almost any other commodity market, we will not see a significant drop-off in demand. And so, in fact, this tends to indicate that we would face an even more extreme supply crisis in the silver market, because unlike other markets where soaring prices immediately cause demand to slam on the brakes and allow inventories to rebuild, this mechanism does not exist in the silver market. And so this market is poised for a total crash. Basically inventories going almost to zero, or maybe even to zero, before some sort of moment of crisis arrives.
Yeah, that means that all the silver bugs are going to profit off of this. But moving forward, I wanted to get into this topic of these MMT guys, which I told you about before we started. The MMT school is pretty much a branch of Keynesianism, and they believe in fiat money. And they also believe that since our debt, or the United States debt, is denominated in our currency, it is impossible to have the nasty inflation that you are talking about, or the Austrian school guys like Peter Schiff is talking about. So what's wrong with their analysis indicating that since we can borrow in our own currency, we won't have to worry about higher interest rates, we don't have to worry about this doomsday inflationary scenario?
Well, first of all, to some extent, this is an argument that has been used with respect to Japan's economy for quite some time. Basically, they have the massive debt that they're financing year after year after year. And, of course, they print their own currency. They issue their own bonds in yen. But the huge difference between Japan's economy and the U.S. economy is that the vast majority of Japanese debt is financed internally. So with an economy where the debt is financed internally through all this money printing, and if, in fact, the economy itself was a totally closed system, then this argument could theoretically have a certain amount of validity. But the problem, of course, is that you have a world full of currencies and a global trading system. And so the idea that any one economy can grossly inflate their money supply, trade that currency in the global economy, and not see the impact of currency dilution is utterly absurd. It's an infantile argument.
Yeah, I also agree with what you're saying, but we could kick the can down the road, or the United States could kick the can down the road, since the U.S. has the world's reserve currency. But you could have a black swan event, which these MMT guys don't understand. last week we saw that the Germans wanted to repatriate some of their gold holdings at the New York Fed, and then they wanted to repatriate all their gold holdings in France. And the French are dealing in Mali right now, and Mali tends to have a lot of gold. I'm not connecting the two, but it just seems awfully suspicious with the foreign events going on over there. So do you believe that you could have a black swan event and then central banks start to not trust each other, they repatriate their gold, the gold prices collapse, fiat money starts to crumble, and this is what could unwind the system?
Well, that's one theoretical scenario and certainly plausible. But the point is that it's not like we have to even sort of work hard to come up with these potential scenarios, because they're already starting. In fact, you refer to the U.S. as the world's fiat currency, and in fact, that is no longer an entirely accurate statement. It's was the exclusive reserve currency. Now it's the shared reserve currency with China's renminbi, because for most of the economies of Asia now, their reserve currency is already the renminbi. That's the currency they do their trading in. And of course, this is the product of all these currency swaps and bilateral trade agreements that China's been rapidly conducting over the past couple of years. And of course, by itself, this guarantees an enormous impact on the U.S. dollar, because as you pointed out, having a reserve currency is an enormous advantage, because it creates a massive artificial demand for that currency. And of course, anybody who understands the fundamentals of economics understands that a surge in demand generates a higher price level than would exist otherwise. Conversely, of course, when a currency goes from being the reserve currency to being a reserve currency, and of course soon not a reserve currency at all, we have the reverse dynamic where there is a collapse in demand, and that of course must in turn result in a collapse in price. So totally independent of the insane level of money printing that's taking place at a hyperinflationary level, the simple transition of the U.S. dollar from being the reserve currency to being a co-reserve currency and soon not a reserve currency at all nearly guarantees hyperinflation by itself, because there are so many U.S. dollars circulated in foreign economies that people are no longer going to want to hold. And, of course, when you dump anything, the price plummets.
Yeah, I actually see a slow but steady decline of the dollar in the short term. Long term, I'm not quite sure. The hyperinflation could occur, in my opinion. But anyways, before I let you go, Jeff, how can people follow your own work again?
Our site is bullionbullscanada.com, and we put out precious metals analysis, economic information, and information on mining companies as well. And then my articles are distributed quite a few places. You mentioned thestreet.com, also La Metropole, and various other precious metals websites. My pleasure.